Today I want to take a look at some very basic tax planning, and I suspect that many of you will already be doing this. What I'm speaking about, of course, is ISAs, individual savings accounts, and these can be quite advantageous if you've got a little bit of spare cash to invest. After this week, there will be just 5 more planning points before the start of the new tax year, a year that's going to see some changes and probably not to your advantage. The budget that has just gone will not be good for many of you. The amount of money that you as an individual can put into an ISA or a combination of ISAs before the 5th of April 2017 is £15,240. This is set to rise to £20,000 next year. But it's important to remember that unlike many other tax reliefs, the annual allowance is lost and not carried forward if you don't use it. So use it by the 5th of April or lose it. So why bother with ISAs? Well, the income and capital gains derived from the ISA are tax-free. You don't have to put the details on your tax return, and as long as the money stays within the ISA, it continues to have the same tax advantages. There are currently 3 types of ISAs: cash ISAs, stocks and shares ISAs, and innovative finance ISAs. There are various types of cash ISAs, and from the 6th of April 2017, a new LISA will be available. An ISA is a wrapping around what would otherwise be the source of taxable income. The same investments held outside the ISA would produce taxable income, and you would have to pay tax on them. We commonly see ISAs now being used as part of someone's pension planning. When you put the money into the ISA, you don't get tax relief. But when you take the money out of the ISA, there are no restrictions and you don't pay tax on the withdrawal. But just like a personal pension, the funds within the ISA are in a tax-free environment. Now, cash ISAs are basically just savings accounts producing tax-free income. They will be especially beneficial for higher rate taxpayers and anybody who's used up their personal savings allowance. At the same time as paying into your own cash ISA, you can contribute to a child's junior ISA, but beware if you put your money into your own minor child's account, because the income remains yours and you have to declare it on your tax return. Help to Buy ISAs are special types of cash ISAs to help first-time home buyers. They will shortly be phased out in favour of lifetime ISAs, the LISAs. Basically, you contribute up to £200 a month, and the government then tops this up with a 25% bonus. The bonus is received at the time of purchase of your first house. You can only have one Help to Buy ISA per person, but if 2 people are buying a house together, they can each use their own ISAs to help pay for it. Stocks and shares ISAs are useful for holding investments, and you will not suffer tax on any income or capital gains for sales of those investments. But many people who hold stocks and shares ISAs don't get any benefit, because even if these investments were held outside of the ISA wrapper, the capital gains will be covered by the annual exemption in any event. Innovative finance ISAs were introduced just last year, and these can be used to hold peer-to-peer loans, sourced from various crowdfunding platforms. I realise we're getting a little bit ahead of ourselves here, but from the 6th of April 2017, the new lifetime ISAs will be available, and these will bring considerable benefits. Basically, if you are between 18 and 40 and pay up to £4,000 per annum, the government will give you a 25% bonus. But more about this next tax year. So this has been a quick reminder of the provisions for ISAs, and in particular a reminder to make sure you contribute up to the maximum that you can before the 5th of April. I'm Alan Long from the Long Partnership, making life less taxing.